Here is some good news for superannuation accounts. The US and Australian markets are sitting at all-time price highs. And if you account for dividends received along the way, if you bought at the peak of the market just before the GFC, your superannuation account is now sitting on gains of over 150%. This chart shows a 15-year history of total returns for the Australian market in green and the US market in blue. And you can see how far we have come since the GFC. Equity markets have averaged returns of about 9% each year over this 15-year period, which includes the GFC. Despite these strong returns, the focus of this video will be why the average investor can still miss out on gains even when markets are rising. I am going to refer to two separate studies which shows that when markets are going higher, it is generally being driven by only a very small number of winning stocks. The first study was done out of Arizona University. They studied the 25,000 odd stocks which were listed on the US market between 1926 and today. They found that half of the market's return came from only 4% of the companies, or about 1,000 stocks in total. This highly profitable group is represented by the size of the blue blocks in this chart. The other half of the market's return came from the green box. The grey area represents all of the other stocks on the market which collectively didn't produce a positive return. So what this is showing is that it is more common for investors to pick losing stocks than it is winners, by a ratio of about 10 losers for every one winner. The next study is done by our own investment partners, Lennox. They studied the 560 odd stocks that made up the Australian Small Companies Index for the 10-year period up to 2018. The green zone represents the companies that made money. The grey zone represents the companies that made slightly negative returns. And the red zone represents companies where investors basically lost all their money. Again, this shows that it is more common to invest in losers by a ratio of 2 losers for every 1 winner. The take-home message from all this is that stock markets have been a great place to invest over the years, but it is also easy to miss out on those gains, particularly if you are an average investor holding a small number of stocks. In our own portfolios, the strategy is to firstly filter out all the losing companies, and we do this by sticking to only the most profitable section of the market. Secondly, we get broad diversification across the winning group, and this ensures we're getting the best possible leverage we can from any gains in the market. And we achieve this via a mix of direct stocks, specialist managed funds, and index style exposures.